learn with joy.
Hi, hello champions. Good morning. I am making this video to discuss MCQ questions from the May 2025 of Financial Management. Just they given three questions in the MCQs. One is from the investment decisions, one more is from the cost of capital, and one more is from the leverages. It is not so complicated. Very simple questions has been given. Let me quickly revise that. But before proceeding further, please subscribe my channel, and whichever the videos that you are watching, if you like the video, just give me one like, and whatever the comments that you are making, it will act as a fuel for me to make more and more videos. If you feel whatever the videos that I'm making is so helpful for you, without fail, please subscribe the channel and share to the people, share the videos to the people who are in need. Okay, now let me start with the first question, which is based on investment decision. Look at this question. Very simple question. I'm reading for you. Linty is a small sized firm manufacturing company. Its manufacturing plant is situated in Chandigarh. Currently, company is labor oriented, due to which there is a less production, delay in deliveries, and more defects in production. The management of the company is considering the proposal to purchase a new automatic machine which will carry out some operations which are at present performed by manual labor. So let us understand clearly. What is this? Please understand what they are stating is, at present some of the operations in the company is doing manually. Now they are planning to replace the manual job with automation. Means in the sense they want to replace the manual job with the machines. So from manual they want to change it to the automation. For that they are planning to purchase the machine. Now look at here. There are two alternative models of machine that are available in the market. One of the machine is TMT number 1 and one more machine is TMT number 2. If machine is replaced, it would provide labor saving and reduce the defects as well. It is expected to have an economic life of 10 years. The life of the machine is 10 years for both the models. Fine. The following details are collected. So, in relation to both the machines, they give us some information. What is the information? First, cost of the machine. TMT number 1 is 45 lakh rupees and TMT number 2 is 50 lakh rupees. Estimated savings in direct wages per annum 15 lakh rupees, 20 lakh rupees. Estimated savings in scrap per annum 5 lakh rupees, 6 lakh rupees. These two are the savings. These two elements are savings which can be treated as the inflow. Next, estimated additional cost of indirect material. This is the outflow. This is outflow. Cost of indirect labor, again outflow. Cost of repairs and maintenance, again it is outflow. So these two are inflows or incomes, and remaining three elements are outflows and expenditure. Okay, next. Depreciation is charged using straight line method or the useful life. Okay, so the depreciation method is straight line method. And if you observe one more thing, nowhere in the question they specified the scrap income of the machinery. So we have to assume scrap income or residual value as a 0. Are you following the discussion? Okay. Company is in 35% tax bracket and expected rate of return may be 15%. Expected rate of return may be 15%. Being a finance manager of the company, you are required to evaluate alternatives by answering the following. So let us see what all the requirements that they are asking. Look at here. What are the annual savings? What is the annual savings from machine TMT number 1? Annual savings from machine TMT number 2. And then they are asking payback period. See, when it comes to payback period, we have to consider the cash flows. We have to consider the cash flow after tax. I already told you. Generally, I used to mention this point. There are Totally we have 7 techniques. Capital budgeting techniques are 7. Non-discounting technique, discounting techniques. When it comes to ARR, out of that only ARR is going to use the profits. Remaining all other techniques is going to consider the cash flows, payback period. How to calculate? Okay, we'll discuss that later. First of all, they're asking annual savings, annual net savings. I will be calling it as annual net savings. In this question, what is happening? They want to make manual job into automation. When they are converting manual job into automation, they're given 2 savings and 3 cost elements. If you net off 2 savings total minus 3 cost elements, will get PBDT. We'll be taking it as PBDT. In investment decisions, we have to consider the tax savings due to depreciation. So that we'll be taking it as PBDT because depreciation is not yet reduced. In those cost elements, indirect material, indirect labor, and one more cost element is repairs and maintenance. Depreciation is not yet reduced, so that we are going to consider it as PBDT. Listen. Simple. First 2 elements will be taken total. We'll be getting annual savings. We'll be getting annual savings. Annual total savings. From this, exclude 3 cost elements. Exclude 3 cost elements. We'll be getting PBDT, profit before depreciation and tax. And then we'll reduce the depreciation. We'll pay the tax. We'll get PAT, profit after tax. This is called as annual net savings. Annual net savings. That is what they're asking. Look at here. Annual savings from TMT1, annual savings from TMT2. I clearly written the solution. It is a handwritten. Let me show you that. Look at this. Calculation of cash flow after tax. In that, okay. Savings in direct wages. See, when the manual job replaced with the machine, there will be savings in direct wages. First, we have to consider that. Next, savings in scrap. Please understand, many students will confuse here by looking at the word scrap. They will assume it is the scrap of the machinery. It is not the scrap of the machinery. It is the scrap from production process. When manually working, scrap will be more. When the machines are working, scrap will be less. So there is savings in scrap due to machines, which we are taking it as inflow. That is the scrap. Next, total savings 20 lakh, 26 lakhs. Which we are okay. That total from that we are going to reduce the expenditure, indirect material, indirect labor, repairs and maintenance. I am excluding that. I am getting PBDT or annual cash savings 12 lakh 50,000, 14 lakh 20,000 minus depreciation. I myself calculated. Look at here. What is the how to calculate depreciation under SLM method? They clearly stated in the question SLM. So how to calculate depreciation? Asset value minus salvage value divided by life of the asset. Mission TMT1 value is 45 lakh rupees, salvage value is 0, divided by 10 years 4 lakh 50,000. TMT2 total value is 50 lakhs, salvage value is 0, divided by 10 years 5 lakhs, 4 lakh 50,000, 5 lakhs. I am taking the same depreciation here. We will be getting PBT minus tax at the rate of 35%, 2 lakh 80,000, 3 lakh 22,000. We'll be getting PAT, annual savings 5 lakh 20,000, 5 lakh 98,000. So this is the annual savings. If they would have asked cash flow after tax, we would have answered this. But what they are asking is net annual savings. Net annual savings is 5 lakh 20,000, 5 lakh 98,000. Please understand, annual savings they are asking. If they would have asked cash flow, then we would have answered 9 lakh 70,000, 10 lakh 98,000. Clear? Okay, now. So 5 lakh 20,000 from the TMT1, 5 lakh 98,000 from the TMT2. That is the answer. Look at the question. 5 lakh 98,000, 5 lakh 20,000, I think. Yeah. 5 lakh 20,000, 5 lakh 98,000. Have you understand this? Next, they are asking payback period. First of all, what is payback period? The time taken to get back the investment amount. The time taken to get back the investment amount is called payback period. We have 2 types of payback periods. Payback period, discounting payback period. Payback period is without time value of money. Discounting payback period is with time value of money. Let me take TMT1. What is the total investment? 45 lakh rupees. Total investment is 45 lakh rupees divided by every year how much cash inflow we are getting. So look at here. 9,70,000. So 45 lakhs divided by I'll show the calculation directly. 45 lakhs divided by 9,75,000. Look at here. 9,70,000. 45 lakh divided by 9,70,000. 4.63 years. Next TMT2. 50 lakh divided by 10 lakh 98,000. 4.55 years. Are you understanding? So this is the answer for the third one. Payback period 4.63, 4.55. Look at here. So option C is the right answer. Next, they are asking average rate of return. What is the formula? Average PAT. Average PAT divided by average investment. Average PAT divided by average investment. How to calculate average PAT? Sum of profit divided by number of profits. How to calculate average investment? Beginning value plus ending value divided by 2. In this question, look at TMT1. First look at TMT1. If you look at TMT1, average profit after tax 5,20,000. Average profit after tax is 5,20,000 into 10 divided by 10. If you want to take average 5,20,000 for the 10 years time, divided by 10 years, both 10 will get cancelled. 5,20,000. Average investment is TMT1 purchased at 45 lakh rupees. By the end of the period, it will be 0. Salvage value is 0. So 45 lakh plus 0 divided by 2. 22 lakh 50,000. So it is 5,20,000 divided by 22 lakh 50,000. Look at here. 5,20,000 divided by 22 lakh 50,000, 23.11%. When it comes to mission number 2, average PAT is 5,98,000. Profit after tax is 5,98,000. So 5,98,000 divided by 25 lakhs. So we are getting 23.92%. So 23.11%, 23.92%. In which option it is? Option B, 23.11%, 23.92%. Correct? Correct. Next, look at the next question. They are asking profitability index. How to calculate profitability index? DISCI divided by DISCO, discounted cash inflow divided by discounted cash outflow. Let me discuss first TMT1. First of all, DISCO. There is only one time outflow. Purchase of machinery 45 lakh rupees. DISCO, I can mention it as 45 lakh rupees. DISCI, we are getting 9,70,000. Yes, 9,70,000 for 10 years time. 9,70,000 is the inflow. 9,70,000 is the inflow for 1 year time. For every year, we are going to have 9,70,000 for 10 years time. So it is an annuity cash flow. 1 to 10 years. 9,70,000. So I am going to multiply with the present value annuity factor at the rate of 15%. They given in the question. Look at here. 15% is the required rate of return. 15% for how many years? 10 years. Present value factor of 15% for 10 years. Present value annuity factor. How to do that? 1 divided by 1.15 is equal for 10 times because of 10 annuities. Press GT. You will get the answer. Look at here. Profitability index DISCI divided by DISCO. Okay. Now TMT1 equal to DISCO 45 lakh. DISCI 9,70,000 into present value annuity factor of 15% 10 years. You will get 5.0188. 5.0188 into 45 lakh. Sorry, 9,70,000. You will be getting 48,68,236. So DISCI is 48,68,236 divided by 45 lakh. 1.08 is the profitability index. When it comes to TMT2, listen. You just look at me. You will understand. TMT2. What is the DISCO? 50 lakhs. They are investing 50 lakhs. DISCI, what we are getting is every year we are going to get 10,98,000 for 10 years. We need to discount using 15%. So 10,98,000 into 5.0188. So you will be getting 55,10,642. That is DISCI. So DISCI divided by DISCO. 55,10,642 divided by 50 lakhs. You will be getting 1.10. Are you understanding? Okay, now So final answer is 1.08, 1.10. 1.08, 1.10. D is the answer. Very simple question. The only point which we need to learn in this question is average profit or annual savings. Annual savings means PAT. Annual savings means PAT, profit after tax. If they would have asked cash flow after tax, then we would have written 9,70,000, 10,98,000. Are you understanding? And whatever I am writing here, the answers what I written, I will share the PDF. I will share the PDF with you. That I am going to attach in the description. You can find that. You can download that. Okay. Now, look at the question number 2. This is from cost of capital based on dividend growth model. Based on dividend growth model. Look at the question. A share of ACB Limited are presently traded at 50 rupees. What is this 50 rupees? Sorry, 51 rupees. P0. Presently trading at 51 means P0 today's price. And the company is expected to pay dividend of rupees 5. Expected to pay. I already told you. If it is in future tense, see how to identify D0, D1. If it is in the past tense, D0. If it is in the future tense, D1. Expected to pay means D1. So this 5 rupees is D1. Per share with a growth rate expected 10%. What is this 10%? G. It planned to raise fresh equity share capital. The merchant banker has suggested an underpricing of 2 rupees. I already told you why we'll go for when the company is going for the fresh issue, they'll be underpricing the share. Why they want to underprice the share? To get the minimum subscription. To get the minimum subscription, they'll underprice the share. In the market, at what price it is trading? 51, which is called a secondary market. Stock market, Nifty 50, Sensex, all these things will be calling it as the secondary market. Primary market is directly company is going to issue the shares. IPO, FPO, these things are called primary market. So in this question, the bank merchant has been advised to reduce the price by 2 rupees. So how much is the price? 51. 51 minus 2, you will get 49. Apart from this, they given 50 paisa is involving the cost. So ultimately, 50, this, see, if you make a total of this, we'll be calling it a flotation cost. We'll be calling it as flotation cost. Okay, now, the cost of new equity share. When it comes to new equity share, KE equal to D1 divided by net to proceeds. If it is existing shares, D1 divided by P0. But when it comes to new shares, D1 divided by net to proceeds into 100 plus G. D1 is known. Net to proceeds we need to calculate. Net to proceeds equal to 51 minus 2.50. You will be getting 48.50. Growth rate is known. Just substitute and we will get the answer. I think 20.31%. Look at here. I clearly given the solution. Cost of new issue KE equal to D1 divided by net proceeds into 100 plus G. Why am I multiplying with 100 to convert into percentage? Okay, now look at there. D1 is 5, P1 is 51, NP equal to 51 minus 2.5, 48.50. G equal to 10%. Substitute the values, you'll get 20.31%. Clear? Next. Question number 3 is based on leverages. That too based on operating leverage. So when it comes to operating leverage, so how to calculate operating leverage? There are two formulas. One is contribution divided by EBIT. That is straightforward formula. Actual formula for that is percentage change in EBIT divided by percentage change in sales. Operating leverage gives what? Let me take an example. See, operating leverage 2 times. What is the meaning of that? EBIT changes by 2 times when there is a change in sales. Operating leverage, I'm telling you again, operating leverage is due to presence of what? Operational fixed cost. When they mention operating leverage 2 times, what is the meaning of that? Change in EBIT with respect to sales. EBIT changes by 2 times with respect to sales. That happened due to presence of the fixed cost. Are you understanding? Look at the question. What they stated. RGT Infrastructure Company has a degree of operating leverage 3 times. 3 times. What is the meaning of that? If sales changes, EBIT changes by 3 times. 3 times. What is the meaning of that? If sales change by 1%, EBIT changes by 3%. If sales change by 10%, EBIT changes by 30%. Change can be increase or decrease. If sales decrease, okay, sales increase by 1%, EBIT increase by 3%. If sales decrease by 10%, EBIT decrease by 30%. Are you understanding? Next, what they given? Sales level of rupees 7 lakh rupees and operating income to 2 lakh 20,000. Fall in sales of the company by 10%. 10%. What will be the result in decrease of operating income? So what they given? They given operating leverage and they given that sales decrease. Sales decrease by 10%. What is the impact on operating income? Operating income is nothing but EBIT. According to operating leverage, it will change by 3 times. That means 30%. So if sales decrease by 10%, EBIT decrease by 30%. How much is the existing EBIT? 2,20,000. So 2,20,000 into 30% is the change, which comes to 66,000. C is the answer. Very, very simple questions given in the RTP. Okay. So by this I'm winding up the class. This video, especially this video. Thank you so much. Okay. Now in the next video, I'm going to come up with the concept called the IRR, internal rate of return. Very, very important. Okay. Yeah.